Hello guys, welcome to the video today talking about entries. So basically what it is that I've had a lot of feedback from those of you on social media who have basically told me that you're having some real difficulties with entries, knowing when to enter, getting a really good entry, and it seems like from those that I've mentored so far that a lot of you are waiting for 4 hour candle closures. And waiting for that to be the trigger. Now, one of the biggest things that I see where traders make mistakes is simply just plotting support and resistance at market structure, and then simply waiting for price to come to that level, potentially respect it, and then they either sell it or buy it. Now, couldn't be further from the truth. There's a lot of things that happen between those zones, between market structure, and as you can tell from my previous videos, that sometimes market structure has less relevance if we have something like a market pattern in play or some sort of Fibonacci extension. So, just saying when it gets to these zones or when it gets to this support and resistance, I buy or sell it, depending on the candlestick formations, it just isn't good enough. It's not enough confluences. So what I'm going to do is I'm just going to show you a few examples today on a number of pairs where basically if we had have waited for the 4 hour candle to close, how we could have got a much better entry if we had have scaled down on the 1 hour. Now, I know some of you guys do this. I know some of you guys do scale down on the 1 hour to 15 minute, and that's great. But the goal is I need to teach you guys how to pick out an area of interest before it has happened. So before price has got there, before price gets anywhere to those levels where you start thinking of buying or selling, we need to predetermine this area way before, sometimes weeks before. So I'm going to show you how you could have predetermined it first, and then how you could have waited for the 4 hour and entered off the 4 hour, or how you could have waited for it first, waited for price to get to that level, and actually simply just been on the 1 hour and waited for the 1 hour entry. So this is how you can get much better entries as opposed to waiting, because the thing is that if we wait for a 4 hour candle to close, one, we're going to potentially miss most of the move, and secondly, we're going to have a really large stop loss, and thirdly, it's just going to ruin our risk to reward. And the idea is that we want to get 1 to 6s, 1 to 7s, 1 to 8s, as opposed to getting 1 to 2s, 1 to 3s. And in most scenarios, that it's just not necessary for us to wait for a 4 hour close. If we've already highlighted that area of interest, it's just not necessary for us to be on the 4 hour. Especially if we've got multiple layers of confidences around that area. Once we get to that area and price finally appears where we hope it was going to appear, we just have to simply get down on those smaller time frames and look for those candlesticks, such as bearish engulfer or bullish engulfing or something like that to suggest that price is respecting where we thought it would. So this is gold on the 4 hour. Now I'm just going to zoom out and show you guys. The simple fact is that we had a fib, right? So from here to here, we hit the 50%. So therefore, you guys know from my previous videos that once we break the 0%, we then target the minus 27. Now, we did reach this area up here. So therefore, as price began to approach, I was beginning to look for entries. Now, we were in this channel up for some time. I have done a full market breakdown of gold. So what we could have done is we could have either waited and we could have basically got in where this black line is, which is this huge bearish engulfing candlestick, because there's no real other candlesticks here that suggest, we do have a spinning top here and here, we do have this slowdown, but to play it safe on the 4 hour time frame, it would have made much more logical sense to come off this big bearish engulfing candlestick. Now, with that being said, it would basically mean that our stop loss would have had to be probably around sort of 100 pips, 110 pips, something like that, which isn't really a great entry. Now for targets, we'd only really be targeting down to the next channel of the line. So therefore that's only a 1 to 2, just coming off this 4 hour bearish engulfing. So let me now show you how we could have got a much better entry on the hourly. Okay, so as you can see, here is the hourly time frame. Now this is the black line that we had drawn for our 4 hour candlestick closure. Now, if we had have waited here, obviously we wouldn't have got a much better entry. Now, I can clearly see that we've actually got a bearish engulfing candlestick here, which meets this channel as well. Yeah, the ascending resistance channel. So therefore, what we simply could have done is gone short straight off this hourly candlestick here, waited for it to close, and put our stops 50 pips above, which halves our stops. which in turn, it basically doubles our risk to reward. So therefore, as opposed to getting a 1 to sort of 1.89, something stupid like that, our target could have been here, which would have given us a 1 to 5, just over 1 to 5, just from simply scaling in on the 1 out. So that's one example of showing how we really did not need to wait for the 4 hour to close. We could have just gone down to the hourly. Now this is another example here. So this is the 4 hour chart on Euro NZD. Now we were making lower lows and lower highs. As you can see, we're being capped by this trend line. Lower lows, lower highs, lower lows, lower highs. Now when we made this lower high and we made this lower low, we could have anticipated that price was likely going to come up to the 78.6, because the 78.6 in this scenario had more layers of confluences because it also met this descending trend line. Okay, so therefore, because of that, we would have known that this was an area of interest. We could have put a marker on our charts to say that when price gets here, or some kind of alerts to say that when price begins to approach this level between the 618 and the 786, that would be looking for to execute. Now let's look at this together. Let me just remove this fib to make things a bit cleaner. Now, most people would have had to wait for this 4 hour candle to close. So they would have seen this one here. Now this candlestick doesn't really suggest anything. This candlestick simply just suggests that we could actually go further. Now, when we then close like this and then form this 4 hour candle, most people would have gone short after the close of that candle. So let's do our short position from here. And therefore stops have had to be above the previous wick. So again, in this scenario here, we're looking at about 100 pips. Something like that. And therefore, obviously, we would be targeting some sort of new low. Maybe down here, something like that. As long as it was below this low, something like that. Now that might not have happened for some time, but that's not part of this video. But therefore, if we were targeting something like that, in a normal scenario, we'd be looking at something like a 1 to 3. Now let's go down to the 1 hour and see how we could have got a much better entry than this. So this is the 1 hour. This is where our black line is. Now you can quite clearly see on the hourly, we didn't need to wait for the 4 hour to close, because you can quite clearly see here, this is a bearish engulfing candlestick, okay, which has engulfed the previous candle. So therefore we could have simply gone shorts off this level here, and as opposed to having a 100 pip stop, we could have done a 50 pip stop, which again has halved our stop loss. It's the same target, it's exactly the same target as the previous person, but instead, because we've halved our stops, as long as we go below the previous low, maybe something like that, as long as we halve our stops, we're now looking at 1 to 7. Yeah, so you can see how now we don't need to wait that long. There's no need to wait for a 4 hour closure. We've already highlighted this area of interest as a 78.6. So we just simply wait for price to approach it on the 4 hour, and then as it begins to approach it, we just scale down to the hourly. So that's another example. I'm going to show you another example here. So this is Euro AUD. Now, as you can see here on the 4 hour, we had this ascending trend line, which was protecting price for some time. So it goes all the way up. It runs for some time. Now, obviously, like I teach you in the other videos, when we break an ascending trend line, we naturally look for a retest, right? Now again, we had this retest here, so when price stops, which it did here, it will allow us to draw a fib, which is what we did. We drew this fib. Now you can see the retest perfectly lines up with the 4 hour 50 EMA, the 61.8%, and obviously the retest of this ascending trend line. So amazing, amazing, amazing entry. This is textbook. It's literally textbook, but the entry could have been a hell of a lot better than this. There was really no need for whatsoever to wait for this 4 hour candle close. So as you can see, if we'd done a 4 hour short from here on this candlestick closure, and we put our stops maybe something like this, I would have probably maybe put something like maybe sort of like a 45 pip stop, something like that. And obviously we would be targeting the minus 618. So that gives us a 1 to 3.35. Not a bad trade, it's not a bad trade at all, but obviously we're trying to refine our entries. So now let's go down on the 1 hour and see if we could have got a much better entry on this. Okay, so this is the 1 hour. Now I can already see a better entry on this. It might not be major, but it is certainly worth entering on this as opposed to waiting for a 4-hour close. I can quite clearly see this is a beautiful bearish hourly candle. So therefore, instead of entering at 1.59 sort of 57, we could have simply entered at 1.5967. So that might only be 10 pips. But look what happens here. So we've got 1 to 3.35. Now let's just move this up to here. That allows us to now shave off at least 10 pips of our stop loss. And then let's rearrange this. So instead of a 1 to 3.35, we've now suddenly got a 1 to 4.55. So that has increased our risk to reward, not dramatically, but it really helps. 1 to 3 or 1 to 4 is a big difference because it really helps us in the long term when we get stopped out on a particular amount of trades. It basically means the more trades, the better risk to reward that we get on each trade allows us to have more losses and still be profitable. So these little techniques of just refining make such a huge difference. So that's another example. Now another example here is, again, it's Euro AUD. Now, as you can see, we had this huge sell-off, okay? Massive sell-off, some major resistance at 1.6350. Now, the first thing that I do with you guys, that I teach you, is the moment price stops, you put a fib on it, okay? So we go from here to here, and we can already see that we've hit the 38.2. Now, another thing that I teach is when we get high momentum trades to the downside or the upside, generally speaking, we normally only get a shallow retracement of around 38.2. Okay, so on this current scenario here, we did get that. We had the 38.2. Now, if we just look at this together, our entry on this particular trade would have been waiting for this 4-hour candle to close. Okay, so therefore, our entry would be off here. So we'd have to put our stops, maybe something like that. And obviously, again, we'd be targeting maybe here. And then if we can get it, we'd be targeting here. Okay, so let's just say we went for somewhere like that. So that trade in itself would be a 1 to 2. Again, there's nothing wrong with a 1 to 2. As long as you're at least getting 1 to 2, that's a good thing. But you and I both know we can get a much better trade than this. So let's now go down to the 1 hour and see how we could have got a much better entry on this as opposed to waiting for the 4-hour candlestick to close. Okay, so this is the 1 hour. Now you can see this black line here where we would have entered on the 4-hour. That was really not necessary whatsoever. We can clearly see that we've tapped, and then we've even formed this bearish engulfing. So if you really wanted to play it safe, you could have got in here. Personally, I would have got in on this this doji candlestick that quite clearly shows that we're rejecting this level beautifully. So therefore, now let's just instead of a 1 to 2.1, let's move this up because we could have basically got in upon the closure of this candle. So let's say here. So therefore, that allows us to reduce our stops. I mean, you could, to be honest with you, as long as you're above this previous wick, but I'm going to play it safe and be realistic. Do something like that. Now, again, if we target down here, instead of a 1 to 2.1, we can now get a 1 to 6. I mean, it was quite obvious that we were going to come up to this level. We've got a high momentum trade, big move to the downside. We're probably going to get a shallow retracement before our continuation. Generally speaking, that normally lands around the 38.2. This was 1 tap, 2 tap, and then you had your bearish engulfing. To be honest, even if you've gotten on your bearish engulfing, that still would have been a much better risk to reward as opposed to waiting for a 4-hour candlestick closure. So that's one trade, and I'm going to show you another example as well, just a little bit further down this particular pair. So let's zoom back out on the 4-hour. Okay, so the next trade here is another retracement here. We've got this other retracement. So let me just remove this and clean this up a little bit. I'm going to remove this and this. Now again, like I teach you guys, when price stops, we don't care why it stopped. We just know that we want to draw a fib on it. So if we go from here to here, we can quite clearly see again on the 4-hour, we've got this beautiful tap again of the 38.2, which makes logical sense because we've got a high momentum trade to the downside with no real retracement. So therefore, we would accept and expect only a shallow retracement of the 38.2. So if we had gotten on this 4-hour close, we would be getting in here, and again putting our stops, allowing enough space to breathe, maybe 60 pips, something like that, and we will be targeting the minus 27%. So again, it's a 1 to 2. You know, it's not an amazing trade, but again, it's nothing wrong with the 1 to 2 trade. Absolutely nothing wrong with it at all. Let me just neaten this up a little bit, because I believe that we've moved there. Okay, so like I said, it's not a bad trade. You know, if you're doing 1 to 2s, 1 to 3s every day, happy days. But you and I both know we want much better entries than this. So let's now zone down to the 1 hour and see if we could have got a better entry than this. Okay, so this is now the 1 hour, and you can see here our black line here is where our 4 hour entry would have been. Now again, it was just really not necessary for us to wait for a 4 hour closure. We can actually see on the 1 hour as well, we've got the 50 EMA, which was helping us with a projection for our fib level, and we could have basically, instead of getting a 1 to 2.3, we could have basically got straight in on this closure here of this candlestick and reduced our stops and put them to maybe sort of 35 pips to allow space to breathe. The target would be exactly the same. So instead of a 1 to 2.3, this now gives us a 1 to 4.8. Much better trade. So that's another example there of how we could have used the 1 hour for an entry as opposed to waiting for the 4 hour to close. Now I'm just going to show you a few more examples as well. Okay, so for the next example, it's GBP AUD. Now this is a beautiful example of basically how we had an ascending trend line, as you can see here. 1 touch, 2 touch, 3 touch. We would have been anticipating our 3rd touch. So therefore, when price stopped, so on this 2nd touch here would have allowed us to draw this trend line, which is what I teach you guys in the previous videos. You need 2 touches to define it, 3 touches to trade it. So you've got touch 1, touch 2, trend line gets applied. We patiently wait for price to stop. When price does stop, we draw a fib from here to here to try and get an idea of where our 3rd touch is going to be. So we would have anticipated this already. Now, some of you would have been a little bit more aggressive and would have probably just got straight in off this hammer, this rejection here, which would have been a fantastic entry. Would have been a really great entry, that. Let me just move this back. But for those of you who are a little bit more conservative and waiting for a bit more of a better signal with regards to candlesticks, most of you probably would have waited for this 4 hour bullish engulfing candlestick. So therefore, if we do this together and we place a long position off here and we put our stops below here, as you can see, that's a very unrealistic stop loss. Now, the first thing I teach you guys is to define your stop. In this scenario, this probably wouldn't have even been a trade from the 4 hour time frame because the stop loss is just far too big. So, but let's check this out together and see what we could have done with regards to targets and see if this would have been a good, healthy trade. So, like I said, we target the 0% and then we target the minus 27. So, we did reach this. So that's a 1 to 4. Okay, so it's risking 188 pips to gain 738. Not a bad trade. Not a bad trade at all. We would have taken some profit off of the 0% and let the rest ride to minus 27%, which obviously because we would have been anticipating a new higher high, which is what we formed, and then a new lower high, and the sequence goes on, as you know. But let's see how we could have got a much better entry on this as opposed to waiting for the 4 hour candle to close. So let's now zone down to the hourly and see how we could have done this a lot better. Okay, so this is now the hourly. So as you can see, we didn't need to wait for the 4 hour to close, which was this black line here. We could have simply got in here. So because we would have been anticipating the 3rd touch, anticipating the 61.8, we didn't need to wait that long. We did not need to wait for all the way up here. We could have just simply got in here. So let's now let's readjust this. We can now half our stops. Well, in fact, better half our stops. Our original stop was 180 pips, now it's 60. much, much, much better. And it's the same target. So we're going for the same target as before. Okay, which is, let me just confirm this. So we would have taken profit probably around 185. Let's be realistic. So we've now basically made our risk reward of 1 to 14. So you can see the difference of just simply going in on the 1 hour as opposed to waiting for the 4 hour. But that is a beautiful bullish hammer candlestick straight after 61.8 and a third touch. It's one of those kind of trades where it's like textbook. We've got multiple confidences. We've got a protective ascending trend line, third touch, 618, hammer hourly candlestick. We didn't need to wait for the 4 hour. And this is how we could have got a much better entry. Same target, but reduced our stops by 2/3, which allowed us to have a much better risk to reward. So that's another example. Okay, so this is another example here. So this is GA as well. So again, high momentum trade. Massive high momentum here. We had the 38.2 tapped, because this is what we're kind of expecting on high momentum trades. Now, as you can see, we had this candlestick here and then this bearish engulfing candlestick. So therefore, for an extra confluence, most people would have entered off this bearish engulfing candlestick, which is absolutely fine. It's some people like to have those kind of confirmations. I don't like to wait that long. So therefore, what they would have done is they would have gone short here and probably done something like a 65 pip stop loss. Let's see how 65 looks. Yeah, I mean, that's actually a little bit tight itself. Maybe sort of 70, just above the moving average. And therefore, their target would have been the -27. And then if they can get it, the -618. So that would have been a 1 to 3.8. Not a bad trade. Fantastic trade. But we want to get a much better entry than that. So let's now go to the 1 hour on this particular trade and see how we could have got a much, much better entry on this. Okay, so this is the hourly. We've now scaled down from the 4 hour to the hourly, and let's see if we could have got a much, much better entry. So I can already see that obviously this is our black line here where our 4 hour would be. You could have entered on any of these candlesticks, to be quite honest with you. You could have entered in here, this spinning top, this doji. So let's say, for example, we entered in off this spinning top. So it would allow us to half our stops from 70 to 35. So we can see rejection, 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 rejection. Coming on the spinning top, put our stops just below, above the first rejections. And again, we'd be going for exactly the same target as the others. Okay, but the difference is our stops half. So now this gives us a 1 to 8.72. So we're doubling our risk to reward. We're doubling it just by scaling down. Okay, so that's another example. So now let's show you the next example. So this is USD CAD. Now this is a little bit more trickier, but what I'm going to do is I'm going to show you that basically on the 4 hour, we began to build this inverse head and shoulders. So therefore, I was anticipating the right shoulder to fall around here because it was equal movements of the left shoulder. And in addition to that, this line here, let me just zone out for a second, is a weekly ascending trend line. Okay, this line here is a weekly ascending trend line. It's protected price for a long, long time, since, well, over a year. That was February 2018, and we're now in coming up from May 2019. So therefore, when I was seeing this left shoulder, and then I was seeing this head and this right shoulder, what I did is I fibbed it from here to here. I can see this zone here was a 78.6. And in addition to that, on the larger fib, I could see that this was also lining up with the 61.8. It looks a bit messy like this, but that's where we were lining up. So we had two layers of confluences around here and another touch of the ascending trend line. So I knew that when I started seeing this left shoulder and this head, I was anticipating a right shoulder. It lined up with the smaller fib of the 78.6 and the larger fib of the 61.8. So I was looking for entries around here. Okay, so let's just delete these fibs to make things a bit cleaner. Let's scale down to a 4 hour. Now on the 4 hour, there's a few entries we could have jumped in on here. So this particular one here, this was when news threw this upwards. And obviously you and I both know it wasn't the news, but the news did act as the catalyst to make this go up in the direction that it needed to go. So therefore, it would have been unrealistic to get in on this huge 4-hour candle. Okay, and again, we had another opportunity here where we had a 4-hour bullish engulfing candlestick. So let's go down to these 2 points and see how we could have got a much better entry. We wouldn't have missed this. Let's go down to the 1 hour. Okay, so this is the 1 hour. So we could have basically got in straight off this candlestick here. So we could have gone long here. And simply put our stops below this point here. So therefore we could have just given ourselves 35 pips, would have been plenty. If we can afford to let it breathe, we should. So that would have been this trade. We'll sort targets out in just a sec. And for this trade here, this huge candlestick here, we would have missed this. But if we zone right in on this level, we can quite clearly see that this candlestick here, this hourly, is a bullish engulfing candlestick. It engulfed the 1, 2, 3, and 4 candlesticks before it. So therefore, we could have gone long off here. And again, put our stops below the previous rejections. So let's see how 30 pips looks on this. Yeah, that's a nice, beautiful, healthy trade. It also clears the previous rejection. So now let's zone back out on the 4 hour and see what we could have done for targets. Now, personally, for this kind of trade, I would have targeted the neckline first because we're within an inverse head and shoulders pattern. Okay, so these are our 2 trades. So for me, I would have probably taken profit 1. Profit 2. So that's a 1 to 5. And that's a 1 to 5.5. So, you know, they're both beautiful trades. This one you wouldn't have even got if you'd wait for a 4 hour. And this one here, instead of your entry being here, your entry would have actually been here. So therefore you would have missed, let's have a look at this, 20 pips. 20 pips. So therefore, if we look at this together, let's just remove this. So you guys just remember this, it's a 1 to 5. Now I want to show you if our entry was here. We've had to put our stops sort of maybe 50 pips. Now suddenly it goes down to a 1 to 3.5. In fact, it's less than that because if we move this back to here, it goes down to a 1 to 3. Just 20 pips can make such a huge difference, guys. It really can make such a huge difference. You know, you can go from a 1 to 3 to a 1 to 5.5 just for 20 pips. Now I'm going to show you one last example, and that's AUD USD. Now this is again, it's a 4 hour. We basically had this move up, we stopped. Now you and I both know when we stop, we throw a fib on it. We threw a fib on it. We anticipated the price was going to come down to one of our fibs. On this scenario, it came down to the 618. We came down and formed this candle here. Now most people would have wanted to wait for a better confirmation because we could have headed down further to the 78.6 or, you know, even changed the trend entirely. So therefore, most people would have basically got in on a long position here on this 4 hour bullish engulfing candlestick. They would have targeted the minus 27%, and then if they can get it, the minus 618. So that would have been, if we put our stops, this probably trade you probably could have got away with. Let's see how 60 looks. 60's tight. It's a tight trade. You probably could have got over 60 pips. Now, that in itself isn't even a 1 to 2. It's a 1 to 1.61. Well, 1.66 even, sorry. So that's not the best trade in the world. So, you know, with that being said, because it's not the best trade in the world, you probably would have missed it. You probably would have missed this trade because the risk to reward wouldn't have been very appealing to you. And you would have looked at it when that 4 hour bullish engulfing candlestick closed and thought, yeah, I'm going to get in on this. But as the main question that I teach you guys, where would I put my stops? You would have looked at this and thought, well, my stop loss would have to go here. The most I'm going to get out of this, if I'm lucky, is the minus 618, and that's if I'm lucky. So therefore, this isn't really that entertaining for me. But we can change that by simply scaling down the hourly and getting a much better entry. So let's now scale down the hourly and see how we could have got a better entry on this. Okay, so this is now the hourly that we're looking at. I've just tidied things up a little bit, so I'm just going to remove this box. So I've been using these boxes to find the references points. Now, I can quite clearly see that we didn't need to wait for this black line. We didn't need to wait for this 4 hour closure. We could have actually probably got in on this candlestick here, to be honest with you. I mean, you could have got in here if you wanted to be aggressive, but this probably would have been the better candlestick because it engulfs the previous candlestick. So therefore, instead of getting a 1 to 1.66, let's now move our entry to here, which allows us to put our stops at 35 pips. And we're targeting the same targets. Instead of a 1 to 1.66, we can now get a 1 to 3.5. So we've basically more than doubled our risk to reward just from going down on the hourly. So I hope this video has helped you guys with entries. It's very important that you predetermine an area of interest and you're one step ahead of the game the moment price has moved in a certain way, so that you can draw a fib. You've got 2 touches, so you draw your trend line, and you're anticipating always where you're looking for price to go. Then when price gets there, there's really no need, because obviously all of our analysis is on the daily, the 4 hour, the weekly. Our execution's always off the hourly and the 15-minute. We very rarely do analysis as such on the hourly. We just use the hourly and the 15-minute for execution. So do all your analysis on the 4 hour. We would have seen this on the 4 hour, on the other examples I've shown you on the 4 hour. But when price does begin to approach an area of interest, there is absolutely no reason whatsoever to be on the 4 hour. You've already got enough confidences to say why you want to buy or sell this, so why would you need to wait again for another 4 hours? You have to bear in mind that if you're waiting for 2 or 3 4 hour candlesticks to close, you could miss out on 12 hourly candles. And 12 hourly candles show you a much better picture as opposed to waiting for 3 4 hour candles. So this should hopefully improve your entries much better and allow you to get a much better risk to reward, which is the key within this game, because better risk to reward means that we can lose more trades and still be profitable. If we're getting regular 1 to 6s, 1 to 4s, 1 to 8s, even one of these scenarios was a 1 to 14, then that means that you can lose. I mean, on a 1 to 14, you could lose 13, 14 trades and still be break even. So we have to make sure that we're always zoning down to get the best entry point possible. And I hope you guys have found this video helpful and the rest of the videos as well. Thank you.